Welcome to TMS Insights. It's now June and it's Jeremy Hook and Ben Clark bringing you an update after what's been quite a tumultuous time in the market. May losing a lot of the ground that we'd seen gain, Ben, through March and April. And now as we come into the end of the financial year, quite a lot going on macro and a lot of stock specific stuff.
Yeah, look, it continues really for the last 9 to 12 months. I think it's been quite a polarised market where there's some industries, stocks, sectors that are really in favour, and there's others that are just totally unloved.
Yeah.
And there's a few reasons for that, which we'll talk about. So, but overall, I think the sell-off in the banks in the last few weeks has been the reason for the majority of the fall in the market. I think fair to say we think banks are starting to look like pretty good buying at these kind of levels, as long as you don't think the property market's about to fall over. NAB and Westpac both on 9% dividend yields now. And I think that has done the large part of the market sell-off.
So I guess there are two big sort of worrying big clouds that are being talked about everywhere.
Yeah.
That seem like they're going to create impending doom on the rest of the Australian economy and the world. One is the housing market and the other is Amazon.
Yep.
And let's talk first about the housing market. I mean, sure, it's had a very good run and it may pull back or slow up. Is the extreme risk that people are talking about in front pages of paper as likely to happen, or is that a bit overstated?
Yeah, I mean, my view is it's overstated, but you never say never, do you? Because I'm sure in New York and London, they probably have the same sense of comfort that we have about our housing market. But I look at the fact that employment is still pretty good in this country. Interest rates are the lowest they have ever been, and so although mortgages and debt per household is high, very high, mortgage affordability is actually okay at the moment. And of course, the style of our debt market and our mortgage market is the evidence we saw in the GFC is that Australians continued to pay their mortgages. Yep. It was other things that were put to one side during that more difficult time, and I'm sure that'll be the case this time. So. But there's been other factors, Jeremy, with the banks is, the bank levy that was announced by the government. 3 of the banks have gone ex-dividend in the last few weeks. And then maybe just a bit of valuation. They might have just got a bit ahead of themselves.
Yeah, so it's a little bit of carnage after a good run and the normal run of the market. Amazon, that seems to be something that's got people running scared. Discretionary retail companies probably mostly, but a few others as well. Do we take that hint and get out of things, or is it something that could actually be a little bit overspoken again?
Yeah, I for me, that's a trickier one. I mean, everyone's got their view on Amazon. I think you can't ignore the threat, because when you see what's played out in markets where they've been in for a significant period of time, there has been some very difficult things happen to a number of businesses. And you can't discount that won't happen here. I think the advantage we have in Australia is that we can look overseas and see what's happened, and retailers have had some time to prepare themselves for the entrant, as opposed to having to deal with them from day dot. And we went to a Wesfarmers strategy day yesterday where there was a lot of questions about Amazon and a lot of talk about it. But you listen to the management who say, I think in the case of Kmart, the board's been over there 5 or 6 times and looked at who's done well and who hasn't and how you prepare your business. Yeah. And we're probably coming into it with our eyes wider open. But it's not to say that there aren't going to be some businesses that are impacted, because I think there will.
So let's talk about Wesfarmers, which is a widely held stock. Australia's largest employer and a top 20 of the listed in the listed space. Yesterday's meeting was an opportunity for investors to understand some of the parts. The market was aggressively selling the stock off yesterday at 2.5%. Again, let's analyse the good, the bad, and the in between really with Wesfarmers. Coles, the margins were shrinking a little bit and they were going to reinvest. Some bad news, some good news, but theoretically taken badly. Yeah,
I think so. I think the business is performing reasonably, but it just reflects what's going on in retail, which is the biggest response from most competitors is to get your prices down and provide better levels of service. And one equals lower margins and the second equals even lower margins. So it is a bit of a race to the bottom. But I think they're doing a good job, and it's still a great business.
And margins are relatively high compared to other parts of the world. So, and again, I think we see this with companies. They announce they're going to invest in their business. The short-term nature of the market sells off. In time, that'll be appreciated. The investment is a smart thing to do. The other part was probably the UK opening of Bunnings under the Homebase brand will be initially continuing to make small losses. That was a small disappointment for the market.
Yeah, I think so. They paid quite a lot of money for that business, and they've obviously had some teething issues, which is not unexpected. I remember when Wesfarmers bought Coles, there was a lot of teething issues in the early days, but in hindsight, it was a great acquisition. And it's not unexpected, but certainly the guidance from the management was that it still probably will be loss-making in the second half of this year. I think they're being very cautious in sort of making sure that they stated several times that unless we can show that a model is working, we're not going to roll out too aggressively, or we're not going to roll out at all until it is working. So I think they're wary about sort of doing a masters, and with good reason. And but I think you back them to get it right. But it is a competitive market over there.
So the parts that are going well. Bunnings continuing to go well. Officeworks doing very well. Decided to shelve plans for an IPO there. Kmart doing well. Target not so well, and the industrials very well.
Yep, that's right. And this goes back to the beauty of Wesfarmers' business model. I mean, I think one thing we take away from it is when you meet a lot of the CEOs running all the different divisions, like they're very humble guys who continue to stress, and women who continue to stress that ultimately they've got shareholders at front of mind, and every decision is made with thinking, will this reward shareholders? And the beauty of the business is that if there's an area of the portfolio that is growing well or has a brighter outlook than others, they can direct capital to that business rather than having to focus on one business. And they've also got a lot of talent coming up through the pipeline. When you see these guys present, it reminds you how important management is. Kmart doesn't sound like a great business, but it's an extraordinarily good business. 40%
return on capital now.
And grown every year for 8 years. And Guy Russo, who presented, was probably the best guy we saw present there. And you back him to turn around Target on the back of what he's done with Kmart, which, as he pointed out to the analysts who were all saying you should close down Target, he said, if I read your research when we took over Kmart, we should have closed that down 8 years ago. So it goes back to the short-termism that exists amongst investors in the market versus companies like Wesfarmers.
And I walk out of that thinking I'd like to find another 20 companies with management as focused on shareholders as Wesfarmers is. So it's a good stock for our portfolios, and the pullback will be opportunities for those who don't hold it to either buy or add to. Now, also news in the market, Vocus, a takeover bid yesterday. We may not dwell on that too much, but stocks that have been beaten down with tax loss selling present opportunities for others, and June's certainly a time for opportunities.
Yeah, absolutely. I mean, it's a feature every year, isn't it? Particularly in the smaller, more liquid stocks, you do tend to see it. On Vocus, I think the advice is hold. The Fin's reporting, a number of other parties are doing the numbers. The opening bid is rarely the last, so we'll just see how this plays out. But yeah, tax loss selling is always something to be having a look at.
Okay, very good. And lastly, I think maybe just look at the economic story overall. GDP was out yesterday, showing 0.3% growth for the March quarter. Not a lot of growth, but at least we're in a positive setting there. A little bit of a surprise on the upside compared to expectations. Overall, Ben, you read of the economy and the market as a whole.
Well, I mean, to me, the market's come back probably to starting to look pretty interesting buying levels now. I still think we'll see a higher market by the end of the year. I think if you take a step back, the economy here is not growing at the rate we'd like to see it. But when in America and in Japan and in Europe, their economies are growing very strongly, and you get the feeling they'll sort of pull us along with it. I think valuations have come back to reasonable levels again, although it's patchy. Our market, I think, is quite messy at the moment. I'd still be quite optimistic, particularly from this point. When we're getting to 6,000, it'll start to get a bit harder to find things you really felt strongly about. Now, there's definitely more out there.
Excellent. Okay. Well, that's all we've got time for in the Insights today. We'll be back again next month with a further update.